The outline of today's webinar begins with a brief introduction to Petro-Teach, and then we introduce our distinguished instructor, Dr. Babak Jafarizadeh. Next, we will follow and listen to the webinar lecture, which lasts approximately 45 to 60 minutes. And then finally, we will have a Q&A session at the end. Petro-Teach is a global provider of high-quality training solutions to the oil and gas industry, and currently we are providing more than 100 training courses through more than 50 distinguished instructors with high track record from both academia and industry. Our training style include public, online, and in-house courses. Due to the COVID-19 pandemic, Petro-Teach is mainly focused on the distance learning. For more information, please visit our website www.petro-teach.com and download the course catalog. Also, follow and find us in social media like LinkedIn, Instagram, Facebook, and also do not forget to subscribe to our YouTube channel to watch the recorded videos and receive future videos. The event today is a part of 20 webinar series that Petro-Teach started to offer from September this year. We had interesting talk by Professor Bahman Tauhidi on nightmare of hydraulic blockage and advanced petrophysics, seismic reservoir characterization, hydraulic fracturing, 3D printing, the future of geology, elements of the fiscal regimes, and impact on the E&P economics, and take statistics by Professor Rumi Iledar. In October, we successfully offered 4 webinars in different disciplines, starting by casing and cementing by Mr. Rusnak, Professor Azin, classical measurement versus image processing, advanced analysis of carbonate systems by Professor Muti, and last, SAGD and solvent SAGD design and analysis for unconventional resources by Dr. Irani. Last month, we also successfully hold 6 webinars, starting by borehole image application by Emine Frahat, application of AI and ML in petroleum engineering by Professor Muhakkik, electrophases, a guided ML for the practice of geomodeling by Mr. Garner, well integrity and management by Mr. Makkar, plug and abandonment of wells by Dr. Khalife, and we ended the November session by interesting talk by Professor Sanizadeh on capillarity improves media. In December, we have had already 2 webinars by Professor Haydari on fundamentals of carbonate reservoirs and the role of geomodeling, the multidisciplinary team by, again, Mr. Garner. Today we will have petroleum investment analysis by Dr. Jafarizadeh, and last but not least, we will end up the December by very interesting talk on a hot subject these days, carbon capture, utilization and storage by Dr. Franek Hasiuk. Please inform your colleagues and yourself. Be aware that all these webinars have been recorded, available in Petro-Teach YouTube channel. If you missed the opportunity to attend or you want to review them, feel free to just watch them on the YouTube channel. They're also available on the Petro-Teach website. The event today is a part of the webinar series that Petro-Teach is offering during this year. For today, we will have Dr. Jafarizadeh on petroleum investment analysis, and we welcome and thanks Dr. Babak Jafarizadeh that can join us today. The presentation today is related to the Dr. Jafarizadeh's valuable experiences and comprehensive research on the topic. Dr. Jafarizadeh holds a PhD degree in petroleum investment and decision analysis from University of Stavanger in Norway. Master of Science and BSc degrees in Industrial and Financial Engineering. Babak is an assistant professor of petroleum economics at Hadiyatwat University, with teaching and research interests in the oil and gas industry's economics of decision making. He works toward combining academic practice with his experience from oil and gas industry to create useful decision insights. Dr. Jafarizadeh was a senior economic analyst in Statoil, today known as Equinor, and working on energy projects from all stages of value chain and in a variety of geographic areas, yet mostly on the exploration of hydrocarbons, which is a very important section in any oil and gas company. His interest in petroleum exploration inspired his research projects on topics such as economic decision analysis, real options, and valuations. Great, thank you very much, Dr. Jafarizadeh, for the nice and for the accepting our invitation today. I would like to just give the talk to you. Let me. All right, here it goes. Yes.
Thank you, Sharon. Thank you. I appreciate the nice introduction, and to everyone else attending in this webinar, welcome. I'm very happy that you decided to attend this. Today, we are going to discuss aspects of petroleum investment analysis as it applies to oil and gas exploration and development. So these are all intimately interconnected, and anything that we do is to support these decisions. So I'm hoping that you can see my screen and you can hear me well. If you don't, please let me know and we'll do something about it. But hopefully everything is okay now. Sharon just presented me, and I would like to just let you know, here is me. I have background in investment and decision analysis with undergraduate degrees in industrial engineering and financial engineering. And in my work experience, I mostly worked on the process of decision making within the company Statoil. Now today is Equinor, and I thought today I can bring some of my past experience, combine it with the analysis and the power of analytics that we expect in our economic decision making, and tell you a few things about how we can make better decisions and what complexities and what subtleties these investment decisions have. So today we discuss the process of value creation, and we need to acknowledge that in the oil and gas industry we have uncertainty. Almost everything about oil and gas projects or any energy projects are uncertain, and most of these projects have managerial flexibility. So the combination of flexibility and uncertainty, they can create value. We can make dynamic decisions and we could create value. So today we are going to discuss how flexibility and uncertainty are related and how flexibility can capitalize on uncertainty. So to explain this, I have here brought two examples. The first example is on the value of flexibility and value of information. I call it multi-prospect exploration, and it's when you have multiple wells to drill, and one of the wells will inform you about future drilling. So how can you make informed decisions in this context? That's the question. The second example that I thought we discussed today is mostly on the value of learning, something even less tangible, compared to the value of information. And to discuss that, I have brought this example, which is something new in the oil and gas industry, is about how to produce electricity for an oil platform. The suggestion in this setting was to bring a windmill and produce the electricity that the oil platform needs through a windmill. And then finally, we will conclude and we will have more discussions. So first, let's take a look at the process of value creation. The question that usually we encounter is that why do we do analysis? Why do we do engineering in the larger extent? Well, any analysis is to support decision making. We do analysis to enable us make good decisions. There's no other reason to do analysis. It's not fun, it's not a formality, it only serves the purpose of making good decisions. So let's take a look at a very simple decision, perhaps a personal decision. We have an example here. We want to buy a pizza. Let's assume that you walk into a pizza bakery and they offer you two deals. Here I'm showing a decision, and within this pizza bakery, they offer you, perhaps you could buy an 18-inch pizza for the cost of $25, or you could buy two 12-inch pizzas, smaller pizza. Again, the cost is $25. So which one would you choose? Would you go for the larger pizza or two of the smaller pizza? Well, here it's a very simple decision to make, and there are no uncertainties. The cost is known, of course, it's $25, and the product that you will receive is also known. You will either receive one large pizza or two medium-sized pizzas. So to make a decision here, perhaps we need to ask ourselves, what are we looking for? Well, when I personally want to buy pizza, I buy it for the material it has, for the eating material it has. So in a way, I'm looking at the area of the pizza, assuming that the surface is uniformly distributed, the topping of the pizza is uniformly distributed over the surface, and the thickness is the same in large and medium-sized pizza, then I'm looking for more pizza. More is better here. So I can calculate the surface of each of these pizzas or each of these products and see how much they are. For the large pizza, the surface is easily calculated by just multiplying pi at the radius of the pizza and to the power of 2. So the amount of pizza that you receive within the large pizza is 254 square inches. And the medium-sized pizzas, you will have twice the surface of pi times 6, which is radius of the medium-sized pizza to the power of 2. In total, you'll receive 226 square inches of pizza. So now, decision making is easy. Which one do you go for? Well, I personally will go for the large pizza because you will receive more pizza. So the decision was really simple. I calculated the surface and I went for the larger surface. But it's me, and I am interested in the surface of the pizza. But you may say that, well, I'm not interested in the surface. I am a specific type of person. I look for the crust of the pizza end. Then what should your decision be? If you are only interested in the crust, then perhaps the circumference of the pizza is a measure that matters. So the circumference of the large pizza is 57 inches, and for the two medium-sized pizzas, the circumference is 75 inches. So in this case, if you're only interested in the pizza ends, the crust, then you should go for the deal that offers you two medium-sized pizzas. So here, through this very simple and fun example, we found that, well, it depends on what you are looking for. The objective of the investment will actually dictate the course of action that you will take. So in the first example, the objective was to get as much pizza as possible. In the second version, the objective was to get as much pizza and as much crust as possible. Again, if you define your objective, it will dictate your course of action. So the same applies to oil and gas. In the oil and gas industry or in the energy industry, we need to know why we are investing in it. What are we looking for? What is our objective in doing all these investments? In any corporation, the objective is to make money grow. And this you can translate it into perhaps other objectives, like, for example, increasing the size of your firm or increasing the stock price. If any of these other objectives are achieved, then it just actually means that you are making your money grow. So just to make things simple for us, the objective in any investment or any decision in the oil and gas industry, it would define it as to create value or to make money grow. So with this, which is a very important finding, we can analyze our investments. We can analyze our decisions, actually. Any decision in the oil and gas industry is actually an investment decision. So let's again look at simplified version of reality. Here I have three examples of energy projects. On the left-hand side, perhaps it's the geothermal example of a geothermal project. In the middle, I have an oil and gas production example. And on the right-hand side is a windmill representing the project to create electricity, to generate electricity from wind power. So what do they have all in common? I would say that, well, there are different engineering designs, but they are having uncertainties. They are intending to extract value from an uncertain quantity. So the simple answer is that they are uncertain resources. On the side of the windmill, you have uncertain wind resources. The wind doesn't blow all the time. It blows some days, it doesn't blow the other days, so it's uncertain. The resource is uncertain. On the oil and gas industry, the subsurface resources are uncertain. Nobody has seen the subsurface. We have only indications of what the potentials of the subsurface are. So based on that, we need to make an engineering design to extract that uncertain amount. On the left-hand side, perhaps in a geothermal setting, again, we have the same story. We don't know how much resources there are, how much geothermal resources there are. We can design an engineering solution that extracts this uncertain amount. So we are dealing with uncertainty all the time, and we need to reflect that uncertainty into our valuation and our economic decision making. So let's discuss more of the uncertainty. If we consider uncertainty, all aspects of uncertainty, we will find out that most projects, almost all of them, they are like bets. We bet on geology, for example. We bet on the oil prices. We bet on energy prices like electricity. So most of the time, they're like bets, and you need to make a good gambling decision. That's all about investing in energy industry. So what is the different aspects of the uncertainty? Perhaps we can take a look at the subsurface uncertainty. On the right-hand side, you see a map of the Norwegian continental shelf. Of course, here is the country of Norway and Sweden. I have gathered information from the website npd.no. Within this website, the government of Norway offers all the information about past drilling from the beginning of the oil and gas industry in Norway. Everything is publicly available, and you can visit this website shown in the bottom to access the information. So I have used that database, and I can say that from the time 1966, the dawn of the oil and gas industry in Norway, up until 2018, there were almost 2,000 exploration wells drilled in the Norwegian continental shelf. Out of these 1,951 exploration wells, they were around 1,248 wildcat wells. These were wells that were drilled into a formation for the hope of getting oil or gas. From these 1,248 wildcat wells, there were only 523 discoveries. What does it mean? It just means that almost a third brought discoveries. The other two-thirds of the wells that have been drilled, they ended in nothing, or in the oil and gas jargon, they became dry holes. So when it's a dry hole, it just means that the multi-million-dollar well that you spent some time to drill, all the money is down the drain. You have found nothing, and it's like all your debt has not paid off. And in that case, well, you have lost. In once in a lifetime situation, you will discover large amounts of oil and gas, and those large amounts will make the future of your companies. But most of the time, here the data shows that you will get a dry hole. The majority of the wells will end up being dry holes. So this was the subsurface uncertainty. And oil and gas projects or any other energy projects, they're not all about subsurface. There is also a economic aspects to these projects, because whatever we do, we are, at the end of the day, we are running a business. You're supposed to sell the produced oil or gas. Here in this graph, you can see the changes in the oil prices over the past 30 days, 30 years. I have shown the amounts in both the money of the day and on today's money. And you can see that it's an uncertain path, and it has not been predictable. Well, it didn't stop some companies and some institutions to predict oil prices. Here I'm showing the historical price forecast by an energy department, which is part of the government. And you can see that in the year 2000, their prediction was that oil prices will stay at $20 and they will remain there for the next 10 years. Well, it didn't happen. Oil prices jumped, they went up, and then they revised their prediction. And these graphs show that they never got the predictions right. The oil prices was always unpredictable, their predictions were always incorrect. So the fact that we have uncertainty in the oil and gas industry, the fact that we have uncertainty in the markets, it just proves any prediction unreliable. So the message is that all forecasts are wrong. There will be always surprises because of the uncertainty. So far, we discussed subsurface and above the surface uncertainty. These are the least two things that I could imagine that affect the value of the energy projects, including oil and gas exploration. So how should we make decisions in this environment of uncertainty and randomness? How should we make decisions? Well, there is no panacea. There is no solution that solves all the problems. The best we can do is to make good decisions. And in order to make good decisions, we need to see if the story that we are telling about the investment makes sense. Then we need to model key decisions and uncertainties within that investment. To analyze them further, we need to forecast, we need to reassess, and we need to make decisions and base everything on unbiased analysis. So that's the only thing we can do when we have uncertainty and unpredictability. So in a very simple sense, we need to always see if the benefits outweigh the costs. If that's the case, then we are creating value. So in any decision, if the expected benefits outweigh the expected cost, then we create value. I'm talking about expected just because I'm acknowledging the fact that benefits could be uncertain, benefits will happen in the future, and because we don't know about the future, they're going to be uncertain. The costs, again, they have a future element about the cost. We don't know about all the costs beforehand. So even the cost could be uncertain. So the expected benefits need to be outweighing the expected cost. So in an uncertain world, we define factors that contribute to the benefits and cost. So perhaps on the cost side, we have the taxes that we need to pay to government. We need to pay operating costs, and first of all, we need to have a capital cost, the capex, the so-called capex that is required to make a project happen. On the left-hand side, on the benefit side, we have, of course, the revenues that we get by selling the produced hydrocarbons. We may charge tariffs to the third parties, or we may get tax benefits like depreciation. But is it all? Well, in the face of uncertainty and flexibility, there are also other less tangible benefits. For example, there is the value of flexibility. There is value for information. How much should we invest in an information that gives benefits more than its cost? How much should the value be? And how should we make a decision about the flexibility? How much flexibility is valuable flexibility? These are a bit more difficult questions compared to the, for example, value of revenues. So in order to do modern economic analysis, we need to be able to perhaps assign a value to value of flexibility and value of information. So which takes us to the example. We need to see the value in an exploration context when we have multiple prospects. So what is the value of an exploration well? We usually drill wells. Most of them will be dry holes. Some of them will be discoveries, and we show this using a decision tree. We would drill or walk away. If we drill, then there is this chance of success, which I show with COS, that stands for chance of success. And if the well is a dry hole with the probability of 1 minus chance of success, we will have to pay the cost of drilling. If we find oil or gas, we get a net reward, which later on we will discuss that. This net reward is the net present value of all the things, all the cash flows that will happen after the discovery. So this is a simple analytic model to help us make a decision. If the expected benefits of drilling outweigh the cost, then we will drill. Otherwise, we'll drop. So this was a very simple case, but in reality, you create value through bets that open windows to other bets. And this sequential nature of the bets is an interesting aspect. So what do I mean by bets opening windows to other bets? Here, let's consider a two-well example. Let's assume that we have identified two exploration prospects. I call them alpha and beta. And we have calculated the net reward, the net cost of drilling, and the chance of success. We can use the older analytical model that I just showed you, and we could see the best course of action in each case. For prospect alpha, I have a decision to make. If I drill, I may find oil with 35% chance, or I may end up with a dry hole with 65% chance. So in case of oil, the net reward is $60 million, and in case of dry hole, the net reward is minus $35 million. I can do the same thing. I can make the same decision tree for prospect beta, and there the net reward is $15 million, and I will get it with a chance of 49%. Otherwise, I may end up with a dry hole with a chance of 51%, and I would need to pay the cost of drilling. So what would economic reasoning tell us to do here? The expected value of drilling on each cases is negative. It just means that comparing the expected value of drilling to the expected value of walking away, 0 is better than a negative number. So the solution would have been to walk away from these two prospects. So this might be a sort of disappointing results. We have identified these two wells, and the economic models tell us to leave them or discard them. Well, we may discuss this in the larger context by saying that, well, these two wells or these two prospects were identified in a neighborhood, and the chances of success are mainly interrelated. We have discussed this in earlier webinars, and here simply we could say that in order for a well to have hydrocarbon in it, it needs to have a cap rock, a hydrocarbon charge, and a reservoir arc. If all three are in place, then we will encounter hydrocarbons. In some locations, one of these elements may be missing. So although we may end up with a dry hole, the information could be used to make a more informed decision on the other one. So the chance of success will be updated based on the information we get on the other drilling location. How can we show this? Well, we can show it in this table using joint probabilities. The numbers in the table in blue, these are the joint probabilities of events that could happen, the outcomes that could happen based on this table. For example, this 23% chance is for the joint event that alpha is success and beta is also a success. For here, this 26% chance is for alpha being dry and beta being a success. So how can I include this, the added information, into my analysis? Remember that my previous analysis only used the marginal probabilities. The ones in green were included in the decision trees. Now I have more information in terms of joint probabilities. So how can I include that? I could use a decision tree, which is a bit larger, and the first set of actions that I could take would be to drill alpha, drill beta, or walk away. If I drill any of these wells, the chance of success would be as I had before, 35% for alpha and 49% for prospect beta. But then, based on the outcome of each of these wells, I could decide to drill the other well. So if I have started by drilling alpha, after the outcome is revealed, I could decide to drill the well beta. And the chance of success for beta in that case would be conditional on the outcome that I have already observed. So these probabilities and the outcomes will be updated. We can see that the second set of probabilities, they all are conditional probabilities, and they were calculated based on the joint probabilities that we had in the previous slide. Now, decision making is a bit more complex because we have a larger decision tree, but anyway, it's still simple. The best course of action would have been to drill beta. If it is oil, then drill alpha. If beta is a dry hole, then we need to stop. We need to drop and not to drill the other well. Following this strategy gives us an expected value of $2 million. It's positive. Remember that if we considered these prospects in isolation, their expected values would have been negative. Now, considering the added information, the expected value is positive. It just means that it's drillable. We recommend drilling based on this course of action, of course. So only if we drill beta first and drill alpha if it is successful, walk away if it is dry hole. Only this strategy results in a positive net present value. Of course, it's an expected net present value. So we calculated the value of information in a way. The added information compared to what we had in the beginning, it just led us to better decisions and a positive value for this project. Perhaps we could quickly take a look at the other example. It's much less structured compared to the multi-prospect exploration. Here we have an oil platform offshore Norway, and we are considering electrifying the platform. The as-is case, or the original case that we consider, would have been to electrify the platform using two turbines, two generators that burn rich gas. And of course, they produce electricity. At the same time, because they're burning rich gas, they produce carbon, they produce CO2. So carbon dioxide is a greenhouse gas, and many companies have incentives to reduce their carbon emissions. So in order to do this, an alternative is suggested. The alternative is to bring a windmill and couple the windmill with one of these platforms, one of these generators. If we do this, then we are using one less generator. And with that, we are producing less of emissions. So which one of these courses of action should we take? Well, as always, we need to see the costs and the benefits. Alternative one is to use two generators that burn rich gas. Alternative two is a combination of a windmill and a gas generator. So for this case, which was actually a realistic case, we calculated the costs and the benefits. And we found that the costs actually outweigh the benefits. The cost in this case was the taxes that we pay, the cost of moving the windmill from somewhere else, close to this area, close to this oil platform. And because the wind is an uncertain quantity, we also needed to have a battery to act as a storage. So whenever the wind doesn't blow, the battery kicks in, produces electricity until we have the second generator on and it could supply the platform. Otherwise, we would lose revenue because the platform runs on electricity. It produces oil or gas by using electricity. So what are the benefits on this case? Well, of course, the government offers better depreciation. We can use one less generator, so we have a saving on generators, and we also get benefits of carbon dioxide reduction. How did we calculate the benefits of reducing emissions? Well, in Europe, there is a price for CO2. There's a market called EU ETS, short for European Union's emission trading system. It sets a price for a ton of CO2 emitted. Well, basically, that's the price for allowance. But if you are reducing your CO2 emissions, you could get the same price for the reductions. So by using one less generator, we had created benefits, and that was in terms of less CO2 emissions, and we could calculate the benefits of less emissions because we had a price per ton of CO2. Well, still, all the benefits, they didn't outweigh the costs, so it was a no-go decision for this project. But perhaps we haven't considered everything. We have considered some direct costs and benefits, but perhaps there are less tangible benefits in this case. The less tangible benefits on this renewable project is that, well, this was a pilot offshore floating windmill. The technology could be used in other projects. And because it is a floating windmill, it could operate in any water depth. The water depth is not a limitation in this case. So it's a new technology. It has some learning on how to operate and how to build, how to integrate it with other projects. That type of learning, that part was not really considered when we did economic analysis on our project. So you could actually see what are the potentials of these benefits. The planet, our planet is a water planet. 70% of the surface is covered with water, and 80% of the wind potential resources are in the deep water. Something that is actually useful because our technology is a floating windmill and it can operate in any water depth. Well, the learning and the technology that was used in that project was later utilized in an offshore wind farm offshore Scotland. It's called Hywind Scotland, and it's the first and the largest floating wind farm. the learning could still be used in other candidate projects. There are suggestions offshore Portugal, offshore United States, eastern coast of United States and Mexico, with some other interesting locations across the world. So it just opens new markets for future developments. And that part, the learning and the value creation from future projects was not really considered when we were deciding on the project that used windmill and gas generator. All these future potentials could have value and they could kickstart by us considering a floating windmill close to a platform. So in summary, there are things that we don't consider and because they're less tangible. The energy projects, all of them are about the future. We undertake them for the hope of creating value in the future. Everything about the future is uncertain. We have subsurface, which is basically our lack of knowledge, and we have above the surface factors. Again, it is about our lack of knowledge, like oil prices in the future. So uncertainty has two faces, perhaps, at least two faces. There are technical uncertainties, like the oil in place or the amount of wind that is blowing and the battery specifications. And there is also a market uncertainty, which is more like the price of electricity, price of oil in the future, price of natural gas in the future. These are all uncertain. The art part of decision making is to intimately combine the technical and market uncertainties. I call it art because it's more than technical science. Valuation, decision making, it has an artistic aspect to it. How to combine these two aspects, technical and market. Finally, all analysis is for decision making. And there is no other way. We either support making decisions or we make decisions ourselves. So all analysis is to support decision making. So this was the presentation. I thought I end this presentation with a message. The mathematician Freeman Dyson, who was also a physicist, he said that the mathematicians are either birds or frogs. And of course, he meant no disrespect. By birds, he meant those that fly high and sees the vista, sees the view. And by frogs, he meant that those mathematicians that consider a specific problem, the details. Frogs usually see the flowers and those that grow nearby. So these are two views of aspects of mathematics, and I believe the same applies to energy industry. Some are focusing on the problems, the details of the problem. Some others fly high and consider the holistic picture. In energy industry, of course, we need both of them. And sometimes we need to be both frogs and perhaps a bird frog to switch between views, to see the details and also to see the view. So thank you very much for your attention today. If you have any questions, I'll be happy to answer your questions. Back to you, Shahram. If you have received any questions, I will be happy to address them now.
Thank you very much, Dr. Jafarizadeh, for very interesting presentation. I think we just need to also talk about the course, and if there is any question, meaning while people are thinking, I could answer the questions that receiving.
Yes,
so
of
if
course.
you please let me know, or you have the course agenda, you can go through it if you have that in your presentation.
I think I can give you the control.
Yeah. That would be great.
Okay, now you should have control.
Yes, while people are thinking of questions, we will have an agenda to deliver a course on exploration, evaluation, and decision analysis. It will be a 3 days online course, will be held on next year as online, 4th to 6th of May, and also 1st to 3rd of November 2021. I think if some information is needed, then Babak can explain a little bit about that.
Well, yes, it's an online course. We will cover many topics, including economic aspects of decision making. We will discuss how exploration decision making are a bit different compared to other decisions, mainly because at the exploration phase, many things are uncertain. More things are uncertain compared to a development case. So how should we make decisions when we have an idea, which is in terms of exploration idea? In this course, well, we cover the skills and the mindset behind having projects that are highly uncertain. We will discuss these two aspects of uncertainty also. There is the technical side, the G&G side, and there's also the market side, the oil prices and the economic aspects. So in this course, we try to marry these two aspects and come up with a coherent and consistent decision-making process. The course contains examples. We will cover some realistic examples that you are likely encountering in the oil and gas industry. We will also discuss some of the less obvious cases like value of information, value of flexibility. The example that we discussed here about the multi-prospect exploration, we will discuss it in much more detail in this course. And we will also discuss the tools that help us make decisions. In this case, one of the tools that we discuss is Bayesian probability, how we include probabilities, how we include learning, and how do we update the probabilities based on new information. That's all based on Bayesian probabilities. And in this course, we will discuss these aspects also. So I hope this brief introduction to this course was useful. Back to you, Sharon.